Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with a friend of mine, investor author Vitaly Katsenelson. I've known this guy for a decade, and he's going to talk about something today that I never ever thought he would do. This week in the Mailbag, lots of great stuff. Inflation and taxes, Kodak, Tesla, and more. In my opening rant this week, I'll talk about Kodak and crony capitalism one more time. There's a little bit more to say about this, and I'm going to say it today. That and more right now on the Stansberry Investor Hour. One more time, guys. Kodak. We've been all over this for the past 2 weeks, right? I told you they got a $765 million loan to get into the drug business. Kodak, the film camera company, getting into the drug business. Turns out in their 131-year history, they actually were in the drug business for 6 years from 1988 to 1994. It was a failure. They got out. And it's notable that they got in 1988, 2 years before the recession set in, right? Typical top of the cycle, diversification kind of acquisition move for a company that's being managed into the ground. So fast forward to the recent episode again, and we're back in the drug business with this $765 million loan from the government. I thought that was just kind of crazy enough all by itself because it sent the stock soaring from $262 on a Monday to $60 at the peak on a Wednesday in the third trading session of the week that week. Just insane. Okay, that was crazy enough, right? Then what did we talk about last week? Well, they granted themselves stock options the day before the announcement. Like, that's not fishy. Like, that's not a crony capitalist move, to just try to rake some of this money off the top for the management team. Okay? Now, this week, there's other stuff going on. So since last we talked, the SEC is investigating this thing, and the loan from the international, the government agency is called the DFC, the Development Finance Corporation. The DFC loan is on hold. And the stock, as I speak to you, is below $10 again. And if you look at the stock chart of the last several days, it looks like it was flatline, like somebody whose heart stopped. And then wham, they hit it with the paddles, and now it looks like his heart stopped again. It's a ridiculous episode, but I feel like I need to clarify something because of at least one feedback email I got. In this case, no, it is not okay for these executives to get stock option grants. It's not okay. And it wasn't okay for them to get them, I don't believe, even back in May, right? I put together a timeline. I wrote a whole piece about this for the Stansberry Digest, and I put together a timeline. And my timeline showed that the executive order from President Trump was May 14th. 2 days before that, Kodak moved $70 million from a Chinese subsidiary to a U.S. subsidiary, quote, in anticipation of an intercompany transaction, end quote. I believe starting up a new pharmaceutical subsidiary constitutes an intercompany transaction, right? So that was actually May 12th. May 14th, Trump issues the executive order and invokes the Defense Production Act and says, hey, let's lend money to companies so that we can produce drugs domestically, because too much drug production is overseas in places like China and India. By the way, if you research that, it's not completely true. We'll talk about that maybe another day. Kodak made the director option grants the first time on May 20th, the day of their annual meeting. So 8 days before, they're moving money from a foreign subsidiary to a U.S. subsidiary in anticipation of a major transaction. Then Trump invokes this Defense Production Act, which is just appropriates money for national security, right? 2 days later. Then 6 days later, they grant themselves these options at premium prices. Then approximately May 28th, according to an interview with the CEO, Kodak and this government agency start talking about its new drug business. Then on July 27th, these idiots grant themselves more options. Then July 28th, and it leaks out. The stock was up 25% that day. The news leaked out. And then July 28th, the big announcement, right? $765 million loan to Kodak. The shares were up fourfold that day. July 29th, the stock price hit $60. And the volume that day is like 160 times the previous day. And the previous day was 22 times the day before that. Next day, July 30th, a fellow called Mike on Non-GAAP Thoughts, which is a newsletter that he writes on Substack, Non-GAAP Thoughts. He writes this article citing these suspicious option grant dates and strike prices. Next day, July 31st, Wall Street Journal publishes an article citing the potential, they said $95 million windfall for CEO Jim Continenza. And there were others on the management team who received the options too. August 4th, Wall Street Journal publishes an article citing a new SEC investigation into the disclosure of the loan and the option grants, right? Because it looked like the news of the loan was leaked out on the 27th, I think, is really what they were concerned about. But the whole thing stinks. And let me tell you something. What I alluded to earlier when I said I need to make something clear about this is not the way capitalism is supposed to work. A corporate management team is supposed to make a lot of money. They're supposed to get $95 million for creating a business that has performed well for a period of time, that has generated, for $95 million, you better be generating, at least $1 billion or more, a couple of billion, hopefully, in free cash flow over a period of time, consistently, right? A real sustainable business for that kind of reward. You don't get paid that kind of money just for getting a loan to be in a business that you were in for 6 years out of your 131-year history and sucked at. Okay, that's not the way this is supposed to work. This is the rankest crony capitalism. The rankest crony capitalism. And crony capitalism is when you get paid for knowing people, right? It starts looking suspicious back in May when they're moving $70 million from China to the U.S. It looks like they already knew they were going to do something. And then, 2 days later, Trump invokes this executive order appropriating these loans for this kind of stuff. And then 6 days later, we start granting ourselves options at prices that suggest we know the stock is going to take off like a rocket ship. Then we do it again on July 27th, just to show you how utterly stupid we are. This is not the way it's supposed to work. What they did here was they just took money from, this is government money. So you could say they took taxpayer money and they said, how can we get way too much of this money in our own pockets? I know. Let's grant ourselves a bunch of options. Okay? You understand now? I don't have a problem with option grants in general. I realize people need to be incentivized. It's just the way things are nowadays, right? To attract good management, you got to pay them what looks like way too much money a lot of the time. But this is not that. This is a management team taking money from taxpayers and really taking it ultimately from shareholders as well. They're giving themselves equity for free that the shareholders have to buy in the market. This isn't the only episode of this you're going to see. There was a smaller episode that I kind of filed this away. I didn't think I was going to mention it, but there was a guy, David T. Hines, in a story in the Washington Post, July 28th. I mean, it's all allegations, so I don't know. I'll just say this poor fool apparently borrowed $4 million in this federal PPP, Paycheck Protection Program. It was part of the CARES Act. Right. The CARES Act was that $2 trillion coronavirus bill that was signed into law in March, and it included $349 billion in forgivable loans for small businesses to maintain operating expenses, mostly payroll. Right. That's why it's called Paycheck Protection Program. So you can just pay your employees, even though maybe you're running a restaurant and they have to stay home because of the COVID-19. Right. So this guy gets almost $4 million from this program, and then a week later, people see him riding around Miami Beach in a Lamborghini, a brand new Lamborghini Huracan EVO, which I guess that's an electric Lamborghini, cost more than $318,000. Again, how stupid is this guy? That's like granting yourself the options the day before the loan announcement. And of course, these things are ripe for this kind of abuse. This is what you get when the government starts literally like throwing money around. All this is done very, very hastily, right? Because we think we have to act. We have to act now. And so this is what you wind up with. You wind up with Kodak, and you wind up with this poor sad sack who thought he wasn't going to get caught when he used PPP money to buy a freaking Lamborghini. I mean, it's, somebody's going to include that in some kind of a TV show, some kind of fictional TV show, because it's just too priceless. So that's where we are. That's where we are in, the state of all things financial in August of 2020. Boy, 2020 is the weirdest freaking year. I mean, things that I won't even get into some of the things that people I know have been exposed to this year, but it's all so utterly weird. When you shut down, who'd have thunk when you shut down the global economy because you're afraid everybody's going to get the flu or whatever, that all of this stuff would happen, that you would get people, in Lamborghinis with government money and, Kodak management taking money out of taxpayers' pockets. Who would have thunk it? Anybody with a brain is the answer to that one. Anybody with a brain. And what you do about it? Well, look, I told you to avoid Kodak, right? Because people look at that kind of action and the knee jerk, the thing that's built into your brain, that's been kind of evolving for hundreds of thousands of years in completely different circumstances that have nothing to do with investing. So immediately, as soon as you see that surge in Kodak, you want to hit the buy button. But I'm telling you, it's deadly and wrong every single time. There's a question about Tesla that I'll get to in the mailbag. Same thing. When you see that thing, opening, or actually it sunk to below $200 a share, Tesla did. And when you see Tesla, below $200 a share, and then wham, and I think intraday, it hit something like 1,700, I want to say. And now it's, I don't know, 1,500, 1,400, something like that. Almost 1,800, the 52-week high. So when you see this kind of action, the natural human impulse is to hit the buy button. But I'm telling you, that is deadly. When you see this kind of action, don't play. Just stay away. Keep your money on the sidelines. And in general, this is true of all sort of, in my opinion, I think you'll get a different opinion from other folks at Stansberry, but in my opinion, this is like extreme, insane melt-up action. And most of that action, you have to avoid it. There are ways to play the melt-up, and you can actually make a lot of money if you do it right. Steve Sugarroot at Stansberry is like the only person, like if you tried to do this, if you think you're going to make money in the melt-up, I would say don't do it without him. Don't do it without somebody who knows what they're doing, because you're going to get run over. And experienced traders will tell you, like around the top, in like 2000, for example, in peak of the .com, the action was insane. I covered this in my newsletter, Extreme Value, a couple of years ago. And I used the example of Apple, and it was just, it's like up 50%, down 50%, up 80%, down, 30, 40, 50, 80%, like that, before it finally peaks and then falls, in the bear market. So when the action gets this crazy, experienced traders are gone. The people who make money trading, they're gone. So, that's really my practical advice based on all this Kodak stuff. Got to give the hat tip to Mike at Non-Gap Thoughts, man. He was all over this. He published his article July 30th, the day after the stock hit $60. That was a Thursday. And the Wall Street Journal published on Friday, and then they published again when the SEC said they were going to investigate, like the following, Monday or Wednesday or something. I don't know. But he was on it first. And it was clearly, the spike in volume and all the rest of it, and the circumstances, a government loan to get into pharmaceuticals for a company that was managed straight into the ground. Come on. This stuff reeks, and you need to avoid it. Okay. I've beaten that horse to death. You get the point. Let's move on and talk to Vitaly Katsenelson. I can't wait for him to tell you what he did in his portfolio that he's never, ever done, that I never thought he would do. Let's do that right now. We have talked about gold a lot on this podcast. Right now, people are asking, what are the chances gold could go to $2,500 an ounce? Well, experts say that it may happen sooner than you think. With rock bottom interest rates driving the price of gold to all-time highs, our top commodities expert, Bill Shaw, has a new prediction. He says he has found what he calls the single best gold business on the planet. Bill thinks this stock has the most upside potential of any gold company with an incredibly attractive ultra-low risk profile. Check out the video Bill made explaining why he thinks this is the best moment in decades to get into gold. He also shares his number one pick for 2020. You won't want to miss this. Go to www.investorhourgold.com. Again, that's www.investorhourgold.com. Time once again for our interview. Today's guest is Vitaly Katsenelson. Vitaly is Chief Investment Officer at Investment Management Associates in Denver, Colorado. He is the author of Active Value Investing and The Little Book of Sideways Markets. His books were translated into 8 languages. Nice. Forbes Magazine called him the new Benjamin Graham. And most importantly of all, he's a personal friend of mine. Vitaly, welcome back to the program.
Hey, Dan, it's my pleasure. Thank you.
Always a pleasure to talk. It's been a while. Let's just dive right in because you've done something recently that's a lot different than anything I ever expected you to do. You actually bought gold. I mean, if you're okay with admitting it in public, I guess.
No, I try not to talk about it in public too much, but sure. Yeah, no, it's kind of interesting. I wrote kind of a 5-page letter to clients explaining this decision. And by the way, we're going to publish it, and it's going to be part of the on contrarianedge.com. And people who want to listen, I'm so much smarter on paper than in person, so they can listen to it on investor.fm. But anyway, and I'll tell you this: I usually love writing. I get up in the morning, I make a cup of coffee, and I listen to classical music, and I write, and I do this on a daily basis. And I hated every minute of writing that letter to clients. And the reason I hated this, there are a couple of reasons. No, really, just the reason I hated this because, first of all, when I was writing this, I felt like I was going to cross a lot of political discussion, which I really hate doing. I absolutely hate talking politics. And I hopefully I didn't when I was done with that. But I was always on the cusp of it, right? And the second thing is I basically was writing negative things about the country I absolutely love, okay? And so like when you and I talked about a long time ago, I was always kind of saying anti-gold is probably overstatement. I was just kind of indifferent to it. Like it just kind of, I'm indifferent I think as much about gold as I think about as cactuses or sunflowers. That's kind of gold and is in the same category as sunflowers for me, let's say. Okay, but over time, as I observed our behavior I kind of to start to warm up to gold a little bit more and more. Or at least I hated it less and less. Well, actually, I become less indifferent. Hate is the wrong is kind of is the wrong word, but I became less indifferent to that. And actually, even like last October, November, you interviewed me. You and I had a great discussion at the Stansberry conference in Las Vegas, and post conference, I did a tiny interview with Stansberry people, and I talked about gold, and I said, you know what, actually, it's not as crazy anymore, just because of like when you start looking at QE, it's not as crazy anymore, just because we seem like to be wanting to destroy currency so much. Anyway, fast forward to today, and this is where it gets interesting. I was thinking about it a month ago, and I realized how arrogant I was. And let me explain what I mean by this. I thought of my thinking in early January, like some mid-January, mid to late January, early February, when the virus was raging in China. And I remember catching myself thinking, yeah, this thing only happens in China. This is a China or Asia thing. This is not US thing. And if you think about it, that's a very arrogant thinking. But the thing is, like, it's a very American kind of thinking, because we are kind of like in the oasis where bad things really don't happen that often, right? It's bad things usually happen somewhere else. And as I was thinking about this, I realized that is kind of arrogant behavior that kind of went to our head as a country. Because think about the US dollar for a second, right? It became a reserve currency for a good reason, right? Because we are surrounded by two oceans. In the north, we have a very polite neighbor. In the south, we have a funny neighbor. I shouldn't say funny, fun neighbor. We have the strongest, kind of the most diverse, the strongest economy in the world. And we are the largest democracy, at least if you look by the size of population, right? I guess India would be the largest start over. US would be the largest economy based on the GDP, and India would be the largest economy based on population size. So we have all these elements why we are a reserve currency, right? And therefore, we were reserve currency. We still are. But I think that the reserve currency it's not a God-given right? It's something you have to continue to deserve. And we were behaving as if it is a God-given right. And if you look at our debt to GDP, and this is where it gets very interesting. In 20 years ago, we had $6 trillion of debt, which was about 30% to GDP. In 2019, we had our debt to GDP crossed 100%. And like we used to look at kind of us, and I use it in quotes, air quotes, at socialist EU, and said, we are capitalists and you're socialists. But you know what? EU's debt to GDP in 2019 was 86%. So we capitalists, social United States, now had more debt to GDP than EU did. And
right, who's the socialist now?
Exactly. And then you look at us now, and over the last 6 months, we basically spent almost 12% of our GDP, or more, probably more than that, on trying to kind of fight the effects of the virus. That is a staggering number, because that number is basically twice as much in terms of percent of GDP to the to the rest as what the rest of the of the world did. It's 4 times as much as Europe and 3 times as much as Japan. And I think by the end of this year, we're going to be at 130% debt to GDP, or somewhere over there. May not be the exact number, but that is an incredible increase. So, and by the way, the Federal Reserve, already went into this owning, $2.5 trillion of our bonds. But now they own 3.7, and by the way, now they also own corporate bonds through ETFs. So, like when you start seeing this, you realize that we are like, I don't think US dollar is going to lose the reserve currency status anytime soon. Not because it doesn't deserve to, but it's just because the alternative, there are no other alternatives really. But I can only, but I can also see how the US dollar will start and then continue for a long decline.
Sure, it doesn't have to lose the status. It doesn't have to lose 100% of its, it's like 60% of global reserves. But what if it just goes to 50% or 40%? I mean, that's all that has to happen for things to change a lot, right?
Yeah, it's kind of interesting. There's an interesting concept I learned in the investing. We usually think in kind of a binary terms, right? 0 and 1. But I think we need to think a lot more in nuances. And what you just said is kind of a nuanced thinking, right? It's it doesn't have to be 60%, it just has to become 50, right? Which is kind of incremental nuance change, right? And I think this is exactly what's, I don't know what percentage is going to be, but I know what the direction it's going to go to. And so from a portfolio construction, we bought gold, and we bought gold in an interesting way. We didn't buy. There's many ways to do this. We could have done it through royalty trusts, and I think that's one way of doing it. I did it we bought in the money call options on GLD, and what we did basically, we took a 1% portfolio, 1% position in the options, but because call options in the have leverage. It's almost like a 4 or 5% position in a portfolio for us. And the reason I want to stress this out, that for me, gold is not the portfolio, it's just a position in the portfolio. Because I don't know what's going to happen next, right? What I just told you is kind of my thesis, and it's may not play out. It's not a certainty. It's a very probable, but it's not certain. So that's why for me, gold is just a position in the portfolio. But one thing we also did, and we've been doing it for a while, we've been buying a lot more international equities, stock, high quality companies that are significantly undervalued outside of the United States as well. And so that's our way to kind of diversify away from the dollar.
Okay, let me ask you this. What do you think? I mean, you bought gold, or in a way with options on GLD. What do you think about something like Bitcoin? You think you'd ever put that in your portfolio?
I think I almost can fast forward 10 years from now, Bitcoin trades at $1 million, and I'm saying, yeah, then let's have a conversation about Bitcoin. No.
That's right.
Listen, I'm not there yet. I'm evolved to it, but right now I can't. To me, it's still, if it go, the answer is no. Maybe it's a digital gold. I mean, who knows? But I'm not there with Bitcoin.
All right. Well, we'll check back in a couple of years.
Yeah. No, it's probably going to go up 20x by then. No.
Yeah.
It's who knows. But what's kind of interesting. Another thing we've been doing is that I think the world today, and by the way, just you almost have to provide context to your listeners, because I am not a doomsday guy by any stretch of imagination, and I kind of almost want you to vouch for me.
Not at all.
Not at all.
Not even close. Yeah.
Yeah. So, but I've been buying a lot more defense companies. Company that make military equipment, that kind of stuff. And the reason, and for us, and we're buying U.S. and European companies in the sector, and for us, that has been a hedge against kind of deglobalization, or let's call it localization. Because if you think about, almost by definition, globalization leads to safer world in the world with fewer wars, because through trade you're more interconnected with other countries, right? and if you trade with somebody, you're less likely to have a war with them. What we saw over last 4 years is the trend into opposite direction. And I think pandemic actually kind of accelerated the trend, because you saw this like when countries were like bickering is probably the right word, about who gets ventilators, who gets PPE, masks, etc. This kind of stuff. The kind of nationalism, sparked, sparked like in March or April. At least nationalist rhetoric has, right? And so as we localize, then I think the world, by definition, if you invert that, the world becoming a little bit less safe every time, the more you do that. And I think us pulling our 10,000 troops we had in Germany away from Germany is a wake-up call to Europe that they may need to kind of spend more money on their defense spending, as much as they don't want to. And kind of, if you think about rise of China, all these things lead to kind of less safe world, and more likely, which I hope not, this is not a wishful thinking, please don't get me wrong, but more likely that we're going to have some kind of escalations, happen in the future. So and the interesting part is, if you think about the defense companies in general, their business is very, very stable, usually not impacted by the virus much. They usually have good balance sheets, and a kind of not a Google-like return on capital, but still a decent return on capital. And a lot of times they pay good dividends. So we are able to kind of accumulate a good chunk of them, and that they becoming a core position in the portfolio, much bigger than gold, by the way, in general. But because I like those businesses. Yeah.
Okay. Have you heard about this thing called Thucydides' trap?
No, but you're gonna tell me. No.
Yeah, I'm going to tell you right now. So there's a Harvard professor named Graham Allison, and he wrote a book called Destined for War about Thucydides' trap. And Thucydides' trap is when there is a world power and a rising world power. Most of the time they have gone to war with each other. Most of the time throughout history, going all the way back to the time of Thucydides in ancient Greece, when one power is rising and another power is already the world power, they will fight. Now, it's not an absolute, it's not a law of nature. They don't have to fight. China and the U.S. don't have to wind up in a war. But, maybe we wind up in some kind of like a Cold War or something, or a cyber war or something like that. I mean, we're already kind of there, right? So what you say makes a lot of sense.
Yeah, actually, I did now that you mentioned it, I couldn't remember the name, but I did read about it. Yeah, I think I heard him speak or something, or yes, I did. So I guess, yeah, you know what? I think the way U.S., well, I shouldn't say U.S., the way we fight our works, like if you think about Cold War, right? Russia and the United States never really had a direct confrontation, but we had it through proxies, right? Through other countries, right? And other countries end up being pawns in this, and I think, who knows what happens in, I don't know which proxies are going to be, which countries will become proxies for that. But it just, you don't even have to have you don't even have to have a hot war for the war to happen. And by the way, just if you think about China, Russia, China, United States relationship, I don't know if you saw what happened yesterday. China put Marco Rubio and 6 other U.S. citizens on a persona non grata list kind of thing. So we are banning Chinese company, like Huawei is a like we already have a tech, basically technology cold war with China. It's already started. And so again, just. This is so uncharacteristic of me. This is not typical. I'm usually optimistic, etc. But but I think I'm becoming a little more realistic now, and I realize I have to be more I have to be prepared for the future where the world is less safe. And as a money manager and as responsible for my clients' money, I need to make these decisions now before they become obvious, I guess. Maybe gold is not necessarily, maybe gold is maybe 3 months into the obvious category. But I think defense, maybe, I may be early on that.
Yeah. Yeah, but you want to be early, right? And they're, like you say, they're good businesses with steady revenues and steady earnings. So you're
and if you analyze them on their own, I mean, so if it has a symmetrical risk reward, because like if the world goes back to being safe, we would still make money. And I'm still, they're still undervalued on their own. Like a lot of them trade like 8, 9, 10 times earnings. So but we'll still make money, if the world stays safe, which is great. If that happens, I'm very happy about it. And if it's not, then the return, then they become kind of almost like call options, and the returns become, double, triple very quickly. So hopefully, again, really hope it doesn't lead to that. Yeah.
I have tried not to talk politics, and specifically on this podcast, I've tried to avoid the topic of politics because we, like you say, we mostly want to talk about investments, stocks, and things. But as I feel the need to become more macro aware. And as I become more macro aware, I have to become more fiscal policy aware and more monetary policy aware. And politics the political monkeys just smear their feces all over these things, and you can't get away from it. It's just the stink of it, permeates the topic. So it's really impossible to escape it. So you have to try to minimize it. But I totally agree. Those aren't good conversations.
Yeah, and I think we get to invest in. We don't get to choose economy we invest in, right? We just, kind of the economic. I'm very when I write, I always I try not to suggest a policy. I'm just trying to say, okay, here's what's happening. Here's how we interpret it, and here's how we adjust for that, right? Which has not been suggestive or critical of the policy, whatever. This is just, and guess what? We do have we are on the way to 130% debt to GDP. I'm not happy about this as American, but that's the reality of that. And by the way, the sad part is, if I ran Federal Reserve in March or April 2020, I'm not sure if I would not have made the same decisions they did. That is the sad part.
That's right.
Yeah, and that's the sad part. I probably would have made different decisions as a Fed chair in I know, somewhere between 2011 through 2019, maybe. But I'm not sure I would not have made the same decisions as they did in 2020. It's just, again, I'm so glad I don't have that job. Yeah.
Right. The pressure alone to act has to be unbelievably overwhelming. If they had not acted, people would be screaming for Jay Powell to be replaced. And so, in other words, it's not even that you, Vitaly, necessarily agree with it. I feel like we're just acknowledging that anyone in that position, it would have been nearly impossible to behave any other way, right? And that's the problem. And institutional finance in general has that aspect to it, doesn't it?
It does. And I think it's just kind of, as I got older, I became a little more empathetic to others, just because it's so easy for me to criticize them, right? But then if I place myself, if I ask myself, if I was in that position, what would I do? I realize, probably not anything much different than what they did. And I think that's the sad reality of the situation we are in.
Yeah, because you and I are human, and put in the same position with the same pressures and the same incentives, how could we realistically expect ourselves to behave any differently? If we ran a big institutional fund, we'd buy the crap out of the FANG stocks. That, it's just the way it would be.
Yeah, but also like if from analytical perspective, you start asking yourself, well, if they did not do so, we know the consequences. Well, that's not quite true. As of today, we know the consequences of what they did up to this point. But what we don't know, the future consequences of what they did, right? But also we don't know what the consequences would have been if they did nothing. So it's a kind of, so you don't know, so we're gonna learn the consequences, the moral hazard they created by doing this, right? Because basically, just let's be, and this is important from a kind of, not for me being critical of them, but this is okay. What they just did basically, if you were an investor that was looking at risk reward, right? Then you basically been penalized over the last 10 years, because every time you did not take risk, you did not make much money. The more risk you took, the more money you made. And that has, in fact, because the Federal Reserve took the, kind of, especially now, took the risk of, like, it's a kind of David Portnoy market where market stocks only go up, right? Or all assets only go up. So the moral hazard it created, because now it basically, what it did, you are incentivized to take more and more risk because there's no price to pay for that. And I think that's, at some point we'll pay a price for that. So that's will be the price of, at some point, that leads to more leverage in the system and higher risk taking, and now combine risk taking and leverage, and that creates an environment that's very that kind of prone to black swans.
That's right. It's their manufacturing tail risk as we go up and up and up. But let me ask you something. So this prompts me to want to ask you about your portfolio. Like, we know the kind of stocks that you're buying, and you bought this little position in gold. What about cash? Are you cashed up right now? Do you have a lot of cash right now?
So it's kind of interesting. We had a huge amount of cash going into the pandemic, not because, like, obviously, as I told you, I thought that, the kind of the pandemic stuff only happens in China. So no, we were going in, we had a lot of cash because we just could not find enough high quality companies that were undervalued. And then when I remember that day vividly, when Italy went on a lockdown that Monday, actually it was Sunday, but when the market, we basically also we had stocks that were close to fair value or approaching fair value. We sold them. So we had plenty of cash going into pandemic, and we basically spent it all over the last 4 or 5 months. So the interesting part, existing accounts I have very little cash. However, and this is, new accounts today have a lot of cash again. So our new accounts are only 50% invested again. So in other words, these stocks I was buying, a few months ago, they appreciated already. So the margin of safety is gone. So they're still undervalued. They're not as, there's, less margin of safety. So, but new accounts today for us are like 55% invested maybe. So we're basically close to pre-pandemic levels of cash balances again.
How about that? Yeah, it all happened pretty quick, didn't it? The stock market was so high, then wham, and then now we're back up. I do want to talk briefly about your recent piece on Tesla. I just wanted to touch on that because you've written a whole lot of stuff about Tesla, and I think anybody who's interested in Tesla, go to contrarianedge.com, and Vitaly's got a lot of stuff. But the most recent thing I thought was hilarious, and I quoted it in something I wrote, because you said, like, the price of Tesla discounts a temporal wormhole into the future. and I thought that was kind of a brilliant little observation, because I like science fiction books anyway. So what do you mean by that?
Yeah. So this let me just give your listeners some overview. I wrote a 37-page analysis on Tesla, which is the longest analysis I ever done in my life on anything. So, and by the way, I really encourage you to go to Contrarian Edge, just sign up, and you'll see that there's a Tesla sign up for that. You'll get it by email, so it's free, absolutely. So, if you look, basically, here's my insight. If you look at market cap of Toyota, a company that makes roughly about 8 to 10 million cars a year, okay, cars a year, it has a $200 billion market cap. Tesla has a market cap of $300 billion. So in other words, it's 30% larger than the largest car maker in the world. However, Tesla is only making roughly 500,000 cars a year, and it's been more or less stuck at that number for the last 2 years, even before pandemic. And by the way, just to make this point very, very clear, I am neither bull nor bear. So I'm not, I'm not a Tesla Q guy either. I'm trying to be as objective as possible. And to make things even more complicated, I own Model 3. And I think this is the best purchase I ever made in my life. I absolutely love the product. Okay, so there is no biases in the sense, like, I'm not, there's zero biases here. But anyway, so if you look at, so the Tesla has a larger market capitalization than Toyota that makes 20 times more cars than Tesla does. And then you start thinking about it. Okay, so the market basically assumes that at some point Tesla will make a lot more cars, right? But the thing is, actually, that's not what market assumes. Market assumes that Tesla is already making these cars, right? Because it's already, it's already making these cars today. So number one, this is why you have a temporal wormhole, because basically it assumes that I don't know how much time it will take Tesla to get to making 10 million cars, but I know it's going to take years and years, right? And market assumes it already has happened. But what also market does ignore is that it took Tesla $25 billion of capital investment to make 500,000 cars. I don't know, maybe they'll become more efficient, etc., at making these cars, but it's still going to take hundreds of billions of dollars of investment to make 8 to 10 million cars, and market is completely ignoring it. So in other words, the capital they're going to have to raise through debt, or through equity issuance, or basically, if they ever become cash flow positive, really cash flow positive, not from environmental credits, then that money is going to have to be consumed by building all these factories. And the market assumes basically that has already happened, which is mind-boggling to me. So in other words, if you look at the Tesla's financials, they're not that much different than they were a year ago. Like, really, just like all their profitability this quarter came from just selling more credits to fiat, and kind of green credits to fiat, and some other German and some other car makers. But the stock went up 5 or 6x. So to me, that's almost Tesla kind of highlights what's wrong with this market to some degree. Fundamentals really, like, the Tesla's fundamentals haven't really changed, but the stock just went up 6x. And I think the stock went up 6x because at first it doubled, and then it doubled again. And I think that it first went up and went up more again, and that becomes kind of self-fulfilling kind of reflexivity kind of thing. Just high prices encourage higher prices, because that's what usually happens in a speculative market. But yeah, that's kind of my thesis on that. And by the way, just to we have a tiny position in the put option and Tesla put options. We established maybe a month ago, right about the time I wrote that article, just because it made no sense to me. Those kind of all black swan options, in a sense that for us to make any money on them, Tesla stock really has to come back down hard. Okay, and so I'm
right,
assuming
so you're way out of the money.
I'm way out of the money, and it's a tiny, tiny position. But but I for the fair, for the but I just wanted to disclose it, just to be fair.
Sure, sure. No, hey, I've discussed Tesla quite a bit on the podcast here, so I wanted to get your views on that.
But then I got to tell you this about Model 3. I don't think I will ever buy another car that is non-electric. After you drive an electric car, you realize that is the future. And it's like me trying to explain kind of a rainbow to a blind man kind of thing. It's like, unless you have driven Tesla, and by the way, like and it has, there are two elements here. There is an electric motor element of that, which is common to any electric car, which is just so much better than a kind of internal combustion engine. And then the second element of, what Tesla has done to the car, which is, I think it's a phenomenal. There are a lot of features in the car that are so much better than any car I ever owned. But my point is this: I don't know if my next car will be Tesla or not. Probably will. Maybe 70% chance today it's Tesla. As the other car companies start making the electric cars, I may change my mind. But I know for sure I will never ever buy ICE car. And the proof of that, I had a minor fender bender, my fault. And my Tesla was in shop for 2 weeks, and I had to drive my wife's car, which used to be my car before Tesla, and I hated those 2 weeks. Like, I could not bring myself, like, every time. So that tells you, like, and again, this is people who are listening to this are going to be be thinking about the battery range, all this, kind of all these things. Read my write-up, and I think in my write-up I address all these issues, and you realize actually you should probably give electric car a test drive. Anyway.
So look, we're out of time, but I do want to ask you the same thing I ask all my guests. If you could leave our listeners with just one thought today, what would it be?
That is such a deep question.
Oh, I know.
I think you need all the assumptions we get used to making over the last 50 years. And I think this is kind of like me buying gold was that, right? Like going through that a pandemic is a good reminder of that. Be used to assume nothing bad happens in the United States. I think we need to re-examine things, and I think I kind of I wrote this article, and I really so just on a serious note, I wrote this article where I talk about Fisher random chess, and this would be 10-minute discussion, so I'm not going to talk about it. But if you read this article, that basically describes how I've been rewiring my thinking for today's environment. How I'm I'm approaching everything from a first principle perspective. In other words, if I knew nothing, if I had no historical background, how would I think about the market, about this industry, all these different things? And so there's this article, you can find it on my website, contrarianedge.com, but it really goes through this kind of first principles analysis, so that would be my thoughts, really.
That's excellent. No, I think I agree. It's a great time to go back to first principles, especially in finance and economics. So that's great. Thank you for that. Look, we're going to be checking back in with you. I know you're going to be invited back. I look forward to the next time we talk.
Thank you, Dan. It's my pleasure. Thank you. Bye-bye.
All right. Well, I always enjoy talking to my good friend Vitaly. He does not disappoint. He always sees things that everybody's looking at from a slightly different perspective. And it's, we check in with each other periodically. And yes, you will be hearing from him periodically on this show. I hope you think that's as good of a thing as I do. All right, let's check out the mailbag. When my friend and colleague Steve Sugarud talks, I listen. Steve predicted the rise of gold in 2003, the top of the dot-com bubble in 2000, and he even called the bottom of the Great Recession in 2009. Steve is once again pounding the table on a new prediction. He believes that a mania will hit the U.S. stock market and take most investors by surprise. He said that thousands, if not millions of dollars will change hands as a result of the anomalies he found in the market. If you want to find out how you can profit from Steve's prediction, he has laid everything out in a video that just went viral. Go to www.investorhourtruewealth.com to watch the video and find out how you can profit in this roller coaster of a market. I watched it, and what Steve found is astonishing. Again, that's www.investorhourtruewealth.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read every word of every email you send me, and I respond to as many as possible. I'm starting to not be able to read the ones that are too long, try to keep them short. And I'm also just I'll never address anything that is from outer space, just too crazy. Just obviously stupid and wrong and crazy. All right, we got lots of stuff today. I'm excited about the mailbag. First up is Chris J. Chris J says, longtime listener, first-time emailer. I'll make it short. Thank you, Chris J. He continues, I feel that expanding the balance sheet through money creation is going to be the new form of taxation. Both have the effect of reducing citizen spending power, that is, taxation and money creation. Both have the effect of creating money for the government to spend. Creating money is essentially a flat tax affecting all citizens and non-citizens alike. Creating money has apparently far less political impact than levying taxes. I don't think most citizens really understand the impact of or the immediate pain of expanding the balance sheet like they do of taxation. Seems far less politically damaging as well. What am I missing? Best, Chris J. I don't think you're missing much here, Chris. The only thing I would quibble with a little bit is when you say that it essentially a flat tax affecting all citizens and non-citizens alike. I think that when you create money and pump new liquidity into the system, the people who get it first benefit the most. So if the Federal Reserve is printing money to buy securities, well, they're buying them from the big dealers, so Goldman Sachs gets the money first. You see? So, that one quibble. Also, in this environment, it seems that pushing interest rates way, way down and therefore levitating asset prices, it benefits asset holders, right? And that's not everybody. So it actually, far from affecting all citizens alike, it really just exacerbates and exaggerates that huge difference between wealthy asset holders and everybody else. Otherwise, yeah, I'm with you. Edward B. writes in and says, Porter, the article regarding Kodak and unpalatable political cronyism was straight to the point. Now, how about a second one on political cronyism, emergent biosolutions, and how unprepared we in the U.S. were for a pandemic? An example of another company rising like a phoenix from political gifts from the forgotten man, Edward B. So maybe I will look into emergent biosolutions, Edward B. But Edward, Porter did not write that article that you refer to in the Stansberry Digest. I did. That was from me. And thank you. So yeah, maybe we'll look into emergent and we'll have another Kodak-like story to tell. Good question. And thank you for the tip on emergent. So our regular correspondent, Lodovik H. writes in again this week and he says, let me ask you an easy question about that Kodak thing. Why is Kodak getting money fighting COVID? What are they doing that makes this workable and a common sense deal? I don't know. They are in the picture business. I hope Kodak will survive. I hate it when things go wrong. I just don't wish it to the people. Maybe he means like the employees and shareholders, but it is part of life. And then he says, I have a question for you. Why is it legal for the members of Senate and Congress to trade with insider knowledge? Just make trading, I assume you mean insider trading, illegal. Okay, and then at the end, can't read your whole thing, Ludwig. There's just not time. Finally, I have a question for you regarding biotech firm Galapagos They have over $5 billion in the bank. No clue what to do with it. What is your idea about it? Keep doing the great work. Best regards, Lodovic H. Thank you, Lodovic, once again. I'll look into Galapagos. Don't know anything about it. And I mention it. Maybe somebody listening to us knows something about it. And maybe we'll report on it. But look, Senate and Congress can't use their knowledge to do insider trading anymore. They used to be able to do that, but they did finally put the kibosh on it. So, yeah, I agree. Why was it ever allowed in the first place? Next comes Ron K. Ron has a really good question here. He says, Dan, I'm interested in your thoughts of the benefits of trailing stops for long-term investing in ETFs. If buying an ETF that tracks a major U.S. index, like SPY or QQQ, with the indices historically always correcting themselves in time, what benefit does using a trailing stop have? Thanks, Ron K. Ron, that's not a bad point, right? If you want to hold one of these indexes for 30 years because you know the compounding over that kind of time frame is probably going to be pretty good, selling ever just makes no sense. Until you get close to that 30-year mark. I mean, if you get a bear market at the 25-year mark, it can be a problem. And maybe a trailing stop could help at that time. But until you're sort of done, getting toward the end of your investing career, a trailing stop doesn't make sense, does it? Doesn't seem to. Now, I'm glad you asked this question because I'm going to add a wrinkle to this, which is that these essentially passive vehicles, they're not really passive. That's the first myth about so-called passive investing. These vehicles are price-insensitive buyers to the tune of trillions of dollars in a year, or maybe $1 trillion or so per year, or something like that. At least hundreds of billions. I know Vanguard took in $400 billion last year, and that's more than $1 billion a day, with 252 trading days. So I think there's a huge amount of money pouring into people whose only algorithm is receive $1 of capital, buy $1 of equity. What if it reverses? Oh, you need $1 of cash? I have to sell $1 of equity. It could get really ugly. At this point, there's enough money in leveraged strategies. And we covered this before. With interest rates going down, the leverage goes up because interest rates going down means bond prices go up, and those bonds are used as collateral for leverage strategies. And they just tend to mindlessly follow the algorithm. Oh, more valuable collateral, borrow more, buy more. And then you get to a point where it reverses because the collateral starts yielding. If it starts yielding negative, and you know that you don't want to hold something that's costing you to hold it. So maybe that reverses those strategies and starts a cascading effect. We'll see. We'll see how this all plays out. But I used to be okay with indexing and think, folks won't get hurt over the long term. But I think we have the potential for, I don't know, maybe sort of a Japan-like outcome where things crash and kind of go sideways for way too long. Okay, Dominic F. is next. I love this, Dominic. He says, I love your show. Keep up the good work. I'm a value investor and proud dad of 2 wonderful daughters, 6 and 9 years. In episode 165, you talked with Amity Schlaze about the school system. Since 200 years, the system has not changed. How do you teach your children financial intelligence? It's not taught in school at all. Any tips? I try to implement the financial education in daily routines and hoping that they are not fed up. Best regards from Berlin, Germany, Dominic F. Good question. And I want this to be as simple as possible. But I do have a tip that I think is very useful. Elsewhere in your email, you mentioned, understanding shares, meaning, equity, buying and selling, and money policy and debt and compounding. Start simple. Don't worry about all that. The foundational skill, the thing that makes the difference, is going to be the skill and habit of saving. And just ingrain that into your girls. Ingrain that into your 2 wonderful daughters, 6 and 9 years. And I would say this to any parent. If you want your children to be financially well off and financially comfortable in their lives, do one thing. Save, save, save. Encourage them to save. Because that habit established early in life and set in stone, it strengthens your character, I believe. And it is absolutely the foundational skill for to carry you through a whole successful investment career throughout your life. I firmly believe that with every fiber of my being. Save, 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 Dominic. That's what you should. That's the thing you need to get them to do. All the rest will follow. Great question. Thank you for that. Cindy K says, hello, I love your show. My question is this, just like with the possibility of government intervention in Bitcoin, why won't the government say once again that they're confiscating gold and make it illegal to hold it or buy it? Sincerely, Cindy K. Well, they did this in 1933. FDR did it. I mean, I probably shouldn't say this out loud on a podcast, but I'm not giving them mine. That's all I'm going to tell you, Cindy. They can't have mine ever. And if my neighbor says, hey, I'll give you an ounce, I'll give you a 1 ounce Krugerrand for your, your guitar collection or whatever, I don't know, whatever it turns out to be, he and I may have business to transact. And if somebody says, hey, I'll give you, 10 Bitcoin for your car or whatever, whatever it is, we may have business to transact. And the government won't have nothing to do with it. That's my answer, Cindy. You do what you think is best. Edward E. says, hi, Dan. Enjoy the program. Always thoughtful. Your interviews are interesting and informative. I've heard you comment several times on the returns of Cisco Systems and wondered if you'd taken into full account the multiple stock splits by the company. Share prices would be lower, but it would also double positions. I'm not sure what that means, but he says, thanks and keep up the good work, Edward E. Yeah, Edward, I've looked at this chart like 100 times. Split adjusted, it peaked at $80 in March of 2000, bottomed in October of 2002 at around $8. I think it was $8.60 actually. And it hasn't been higher than 58 or 59 since. So it has not recovered to its dot-com peak. And the point of this is, investors lacked the imagination. They couldn't imagine that Cisco wasn't the no-brainer stock. It was in 10 of the top 10 mutual funds of the time. Everybody said it was the no-brainer. No matter what happens, they're selling the plumbing of the internet and the thing will grow and grow and grow and grow for 30 years and the stock is going to be hundreds of dollars a share, blah, 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 blah. Didn't come true. Didn't come true because the investors lack imagination at these moments. And I believe we're at another one. No one can imagine that Amazon isn't the greatest thing in the world. No one can imagine that Facebook and Google and Apple at, in the 400s at 2 trillion market cap. People simply can't imagine that these aren't the greatest businesses now and forever. I promise you they will be disappointed. When? Well, I'm not in the when business exactly. But that's a great question. Thank you for giving me an opportunity to rant about that. One more to go. Shannon F. is the last one this week. And she says, hi, Dan. Can you please attempt to explain the 5-for-1 stock split of Tesla? How is this even possible given that it is not even profitable without creative accounting gyrations? Shannon F. I don't completely understand the question. The 5-for-1 stock split is just... it's bookkeeping. It doesn't affect the value of the company. It's not based on the fundamentals. It has nothing to do with the profitability. Now, if you're kind of implying a question, if you're saying, how did this thing get to, peak at almost $1,800 and it's $1,500 to the point where they feel like they want to split the stock or whatever? How did it get this far? How did it get to a market cap in excess of 300 billion at one point? That's just a function of the craziness of markets. It happens. It happened in 1929. It happened in, with the go-go 60s, the late 60s, early 70s. It happened in the 90s. It happened, right before the financial crisis. It's happening now. It's just something that people do every now and then. They go crazy for companies that aren't making any money because they love the story. Boom, done. That's it. But yeah, so they'll split the stock 5-for-1. And I remember when I first got into this business, there was a fellow whose name I will keep to myself, who's actually a good guy. I got nothing against him. But at the time, I was saying, it was like 1999, early 2000. I was like, man, I want to short the daylights out of some of this stuff. I want to short Yahoo. I thought it was ridiculous. And I remember his objection to this idea. He says, you're crazy. This thing's going straight up every day. And he kept saying, they're going to split the stock. They're going to split the stock. because the average know-nothing idiot trading stocks at home in his pajamas thinks that when you split the stock, well, hey, if they split Tesla from 1,500 to 300, last time I bought it at 300, I made a bunch of money. So I'm going to buy it at 300 again. I'm going to make a bunch of money. Meanwhile, you're requiring the market to value the thing even higher, right? The market cap doesn't change when you do a stock split. That's the point. It's just the amount of outstanding shares goes up by 5 times and the share price adjusts down to 1/5. And, I don't know, people think they do this to make the stock more liquid or to make it more attractive to smaller shareholders or something. I don't know. I don't know what they think, but they're wrong. It's stupid. And it just reminded me of that episode because I know there are people out there who are going to say, oh, yeah, I can't wait to get my hands on some juicy Tesla shares after the split. Idiots. Craziness. All right, Shannon, thank you very much. That's the mailbag this week, and that's another episode of the Stansberry Investor Hour. I'm having way too much fun as this. I hope you're enjoying this as much as I am. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. Our handle on Twitter is @investor_hour. You have a guest you want me to interview? Drop me a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.